Okay, today we're going to walk through some of the top blogs and our original investing commentary and content on the Validea Guru Investor blog for the week of April 2nd, 2021. And to start, Jack, I think it'd be good to hear about your article this week, which was on the momentum sort of factor, or how momentum can sort of change over time. So do you want to talk about that?
Yeah, so there are a lot of misconceptions about momentum. People tend to associate momentum with growth stocks. So, stocks with fast earnings growth or fast sales growth or something like that. But the reality is those two have nothing to do with each other. Momentum is really just about one thing, and that is the price of the stock going up in the intermediate term? And so if the price of the stock is going up in the intermediate term, momentum could care less why it is. It could care less because it was cheap to start and it got more expensive, or earnings were growing, or, it's a low volatility stock. It doesn't care. All momentum cares about is that a stock is going up. And so one of the things I wanted to do in the article is sort of create this separation maybe between growth and momentum. And so one of the things I did is I looked at the big growth companies of the past decade. And then I looked at, in the past decade, how often of those growth companies, if I took a portfolio of the top 10% of the market based on momentum, how often would some of those growth companies have been in it? So I figured the FANG stocks were probably the best ones to look at for this. So I looked at them. And what I found is, Facebook would have been in that portfolio 14% of the time, Netflix 44%, Amazon 21%, Apple 16%, and Google only 3%. And so what this means is even the biggest growth, the companies that were the most successful growth companies in the past decade, the vast majority of the time, they would not have been in the top 10% of the market based on momentum. And that's due to what the title of the article was, which is the changing nature of momentum, which is those companies certainly had momentum over a 10-year period, but there were periods in there where they did not have momentum. And so all momentum is doing is it's shifting to whatever the stocks are that are going up the most in the intermediate term. So for some of that period, it was growth stocks, but you had some sort of fake outs where value did well, or you had low volatility stocks that did very well. So momentum was just constantly moving between these factors based on what had the most intermediate term momentum. And we have an interesting thing coming up now with momentum because we've just gotten to the 1-year anniversary of the market bottom. And now you're actually seeing a situation where value is becoming momentum, which we haven't seen in a long time. And so what you're seeing, and I showed this in the article, is that same hypothetical portfolio with the top 10% of our database based on momentum, that has a lot more value in it now than it did a year ago. And it has a lot less low volatility, which has been the worst performing factor than it did a year ago. So the point of the article was just to say, you just want to look at momentum as stocks that have gone up, and you don't want to try to judge momentum based on, it's this type of company or it's this sector or anything like that, because it's going to change depending on what's going on in the market.
Yeah, that's a very good point about where we are today, which is, a lot of these value stocks that were almost left for dead a year ago, they're the ones that have come back the strongest. And so as these firms and funds that utilize momentum as one of the inputs to select stocks, you're going to start seeing this change where, the stocks that may have been more growthy type stocks, technology names and so forth, they're going to be being replaced with these, more value-like companies that are exhibiting momentum. So it was good. It was a good article for sure.
Thank you. It's interesting because a lot of these sort of big momentum ETFs, I think Corey Hofstein said, I think that it's in like the April-May timeframe where they're rebalancing. So it's going to be interesting to see what the market impact is as you start to see if value continues to do well, or the types of companies that have done well in the past year continue to do well. It's going to be interesting to see how these momentum funds rotate in and if that has an impact on the market. What was our podcast this week?
So we did 2 podcasts. Our guest was with Adam Mead. Adam is the author of a new book, The Complete Financial History of Berkshire Hathaway. He spent 5 years writing what has basically become an 800-page book about the history of Berkshire and Buffett. And that was a really good podcast. I think we both sort of learned a lot about Berkshire Hathaway, especially some of the early days with Berkshire. So, we talked about like the origin story of Berkshire Hathaway and some of the early companies that Buffett was involved with. We talked about Buffett's best and worst investments, some of the key traits that Adam thinks has kind of contributed and led to Buffett's success. And then he kind of concluded, and you can tell he's very passionate about sort of the annual meeting of Berkshire Hathaway, which I think he's been attending since 2012, although last year, obviously they didn't do one during the shutdown. But, he just had a lot of, I think, interesting sort of tidbits and nuggets and historical perspective. And one of the things we did with that podcast is we put some charts in there. Like, for example, one of them was showing, some of Berkshire's largest acquisitions. And, there's examples where there was large acquisitions that were made over time, but those companies have kind of become like rounding errors on Berkshire's balance sheet. So it's just interesting to see sort of over time some of these companies that Buffett has bought, and then they actually didn't end up being like home runs for him. And they still are Berkshire Hathaway companies, but they're not necessarily these major jewels, as Buffett calls them, like Burlington Northern or Berkshire Energy or Geico in the insurance operation. So that was a good discussion.
Yeah, it's interesting for me. I mean, you tend to follow Buffett and Berkshire a lot more than I do, but I mean, this might be the podcast we did where I learned the most, just because of my own lack of knowledge. I mean, I was sort of surprised at how little I know about some of the acquisitions and some of the best acquisitions, that most people don't know about. And I know very little about Berkshire's history. So, I'll definitely buy the book when it came out, but also it was enlightening for me to sort of learn all this stuff. It's usually you teaching me this stuff, but in this case, I learned a bunch of different things I didn't know going in.
Yeah, that's good. I'm glad that you kind of took some stuff away from it. And the second one was just about one of the models we run on Validea. I won't spend too much time on this, but it's the strategy we base on the Motley Fool's investment guide. And this is basically a small cap growth investment strategy that kind of incorporates growth, momentum. There's some quality stuff in there. There's some ownership or trying to find smaller companies that are maybe undiscovered. And just one of the interesting things with this particular model is we've been running it since 2003 in real time. And what we talked about during the podcast is, it was probably, in terms of expectations, the model we had the lowest expectations for, just because it really didn't have a long-term track record behind it. It wasn't based on some great investor, which the original models on Validea were based on people like Benjamin Graham and Peter Lynch and Buffett. And so the Motley Fool, while it's not a household name, it wasn't, a sort of great investor name, if you will, like those other investors. But since that time period, since '03, it's been the model with the best long-term performance, probably helped to some extent with the tailwind of growth over value over the last 12 years. But still, it's just been a really robust model. And that's, one of the interesting things with this is it's hard to know, whether or not a strategy is really going to be good. You have to kind of see it at a sample and see how it does.
Yeah, it's interesting also because it's definitely our most stringent model. I think it has the most criteria, but it also, it tends to very rarely have companies that meet 100% of its tests. And as we talked about in the podcast, that leads to us, usually filling out our portfolio with stocks that score in the 90s or the 80s or something like that in terms of the percentage of the criteria it passes. But it's interesting that it's our most stringent model. And it's also interesting, like you said, that it's, we didn't expect it probably going in to be the best performer.
What article kind of stood out to you this week?
It was an Aswath Damodaran interview on CNBC that we highlighted on the blog. And, he's very interesting to me because I try to follow people that are the opposite of us as much as I can. And, he is, with us being quantitative investors, he is the opposite of us. I mean, he does really, really detailed write-ups where he, gets at the intrinsic value of a company. And so just in general, I like to follow everything he does because I learn a lot from him because he's the opposite of what we are, which is, these quantitative approaches to investing. But he was talking about the market and how traders and sort of investors and the balance. I'll read a quote from it. He said, markets have always had a mix of traders, investors who care about price, and people who care about value. Value investors need traders to provide liquidity. Traders need value investors to provide a sense of balance. He added, however, that markets get into trouble when one group gets too large, and traders represent that group today. So he's talking about what a lot of people have talked about, which is this whole weighing machine, voting machine idea. And, does anybody care about what these businesses are worth right now? Or is everybody just trading to try to make money and, hoping the next guy is going to buy it for more money? And, these things can go on for a really long time. But just when I think I always pay attention when I hear someone like him talking about, well, this may have gone too far. We may not be caring about the value of businesses anymore. And traders may be playing too big a role in the market because that probably, that's not a timing call, but it probably means we are going to experience some problems in the future here. And probably at some point, the value of these businesses is going to start mattering again.
Yeah, like ultimately, the value needs to be in the long run tethered to the underlying fundamentals, right? And so stocks just don't, the trees don't grow to the sky and stocks don't go up forever. And so that's something that, at some point, the valuations, and maybe they're already there with some companies, they get extended and then there needs to be sort of a flushing out of that and a reset. And his website is full of spreadsheets and articles. And when he writes an article or does a deep dive on, a company or an industry or a sector, I mean, these are lengthy, meaty articles, and they're usually accompanied by a spreadsheet that you can download and utilize, and or like a YouTube video. So he's really bringing his, investing course, if you will, to the masses through his website and his the email he sends out and stuff. Like he when he puts out an email, I'm always reading it, and it takes me like a while to just get through, digest it. Sometimes I try to watch the video as well, just to really wrap my arms around like what he's trying to teach and educate investors. So it's a really valuable resource, that what he's doing over there.
Yeah, we probably could never get him, but he would be a great guy to get on our other podcast, because we would learn so much from like digging into that approach of how you create this ground up valuation, especially for these growthy type companies that are very hard to value, because he's good at valuing companies pre-cash flow or pre-earnings, and he has models where he can model all that out and create like an intrinsic value for the company. So I think that's a really interesting thing, and it's very different than what we do. So we'd probably learn a lot. What was your article this week?
So yeah, it was a Bloomberg piece, and it was about Robinhood, and it was based on an academic study that basically showed that Robinhood traders packed a much bigger punch than the size of their assets, actually 5 times as big. And what these researchers basically estimated was that that Robinhood, due to like kind of the areas and the types of stocks that they were buying, it was a lot of small cap names, but they had a lot more impact given the aggregate size of the assets that they were putting to work. So I think what they said is they found Robinhood traders only had a 0.02 aggregate share of U.S. market capitalization in terms of stock values. So, I mean, they were, far less than 1% and less than 0.5%, but they accounted for 10% of the variation in stock returns in the second quarter of last year. So that would have been from March 31st, 2020 through June 30th, 2020. And if you remember sort of what was happening at that time, the market had kind of fallen off a cliff, and then basically in early March it bottomed, and you saw this sort of huge spike in retail trading and activity. And I think the idea there is they were just quicker to react. They kind of go into why this is. I mean, some of it might have had to do with options. Some of it might have had to do, of course, like we talked about, with the types of stocks that were moving around. Some of it had to do is they reacted more quickly. So there was like these ideas about what contributed to sort of that outsized influence over, some of the performance of stocks. But they also kind of ended with, if this is true, you could see, higher equity volatility in the future as more and more of these Robinhood traders sort of make moves like they were doing and, get more active with their trading. So, that'll be to be determined. I sort of think that maybe some of this, while I think the retail traders back, I think maybe the peak in terms of trading and option activity and just everyone in there, it's maybe that is, at least in the short run, behind us. I think that that was a new thing then, and some of that newness sort of wears off, and I don't think the returns are going to be nearly as strong, at least in the what we saw in the second quarter last year, and what we've been seeing more recently is like crazy returns to the upside, and we know that those don't go on forever. So as those returns come down and get more normalized here with time, you would probably see a drop off in trading activity as well. But who knows for sure? No one can really say.
Yeah, I thought this was interesting too, because it's interesting to see research to back up what people have been saying, what all of us have been seeing in the market. A lot of people have talked about, well, these Robinhood traders are having a huge impact on the market. Well, this is sort of a study that backs that up. And like you said, how this plays out going forward may determine market direction a little bit. I don't know if you saw this, but there's like call buying is way, way down now. So it sort of gets to your point. A lot of people thought this call buying is here to stay, and maybe it'll come back. But, right now, one of the reasons volatility is so far down in the market is that this call buying is not going on. Everybody thought people would get these stimulus checks and they'd go out and buy a bunch of call options, and it hasn't happened. It hasn't played out that way. So I think it's important. It's interesting to see this research, because I think this will affect the way the market plays out in the future. Do these people continue trading aggressively? Do they continue using options? Or do they maybe go back to their everyday life and they don't get involved in the stock market as much? And that may have a big role in where the market goes, but also the volatility of the market as well.
Yep. Time will tell on that stuff for sure. All right, guys. Thanks for watching this, and we will see you next week.
Thank you.
If you'd like to keep up on the research, writing, and curation we're doing at Validea, please go to blog.validea.com to learn more and stay updated. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonneau. Thanks so much.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.